a calm, no-nonsense explanation. So let's say you've reached that point in life. You've saved some money. Not enough to buy a house, not enough to retire, but enough that you're thinking, okay, I probably shouldn't just let this sit. And then you look around. Stocks, shares, equities, bonds, real estate, crypto, NFTs, Forex, futures, fine art, watches. And somehow every option comes with a YouTube ad promising freedom, Lambos, and early retirement. At the same time, there's this quiet fear in the back of your head. What if I lose the money I worked so hard to save? That fear alone keeps most people stuck forever. So let's slow everything down. No hype, no shortcuts, no pretending this is easy. This is investing for beginners, explained like a normal human. The entire point of investing is very simple. Money should make more money. That's it. Let's say you've saved $1,000. You earned it through your time and effort. Now you have a choice. You can put it under your mattress, you can leave it in a normal bank account, or you can invest it. The problem with the first two options is inflation. Right now, that $1,000 might buy you something useful, but 5 or 10 years from now, it will buy you less, not because your money disappeared, but because money slowly loses value over time. Inflation is quiet. It doesn't feel dramatic, but it slowly erodes your purchasing power. Investing exists to fight that erosion. When you invest, you're not trying to get rich overnight. You're trying to stop time from stealing your money. So how does money actually grow when you invest? Very simply, when you invest, you buy something that produces value over time. There are usually two ways this happens. The first is income, the second is appreciation. Let's use a house as an example. You buy a house today. That house can make you money in two ways. One, someone pays rent to live in it. Two, the house itself becomes more valuable over time. That's easy to understand because rent feels real. With many other investments, you don't get monthly rent. Instead, you buy something now and hope it's worth more later. This applies to stocks, businesses, art, and even skills. At this point, you'll hear about lots of asset types: stocks, bonds, crypto, funds, collectibles. That list gets overwhelming very quickly. So instead of trying to understand everything, we'll focus on one core area: stocks and shares. Because for most normal people, this is the easiest place to start. When you buy a stock, you are not gambling. You are buying ownership, a very small piece of a real company. If you buy shares in a company, you legally own part of it. Not the building, not the logo, but the business itself. And that ownership can make you money in two main ways. The first is price growth. If the company grows and becomes more valuable, your share becomes worth more. You can sell it later for a profit. The second is dividends. Some companies share profits with owners. They literally send you money for owning the stock. Not all companies do this, but many large established ones do. So far, so good. But here's where beginners get stuck. How do I choose which company? Apple? Netflix? Amazon? Energy companies? Retail brands? This is where most people make mistakes. Unless investing is your full-time job, picking individual stocks is extremely hard. You're competing against professionals, people with teams, data, experience, and algorithms. And even they get it wrong, often. So instead of trying to outsmart the market, there's a simpler approach. Own the market. This is where index funds come in. An index fund is just a basket, a collection of many companies bundled together. Instead of betting on one company, you spread your money across hundreds. When you invest in a broad index fund, your money is automatically split across many companies based on their size. If the economy grows, your investment grows. You're not trying to be clever, you're making a long-term bet on human progress. This approach reduces risk, removes emotional decision-making, and saves time. That's why many long-term investors prefer it. To invest, you usually need a platform, often called a broker. Which one you use depends on your country. The exact name doesn't matter as much as a few basics. It should be regulated. A calm, no-nonsense explanation.